Welcome back to the show. My name's Mighty Mike, and today we had the Fed meeting. Everybody's expecting that they're going to do another 25 basis point hike next month, and then they're going to pause and maybe even cut rates by the end of the year. For this reason, the whole market has been pumping, and according to my Discord, even Carvana is on the rise to the moon, which is totally crazy because that company is absolutely dead. But I'm going to tell you why the markets might actually be wrong and why we might actually have more interest rate hikes to come than everybody thinks. But before we get into that, I have some really big news for you guys. This channel no longer belongs to me. It now belongs to one of the 7 lucky gods of Japan, Ibisu. He's a god of wealth and prosperity, and they say that wealth and prosperity will come to anybody who evokes his name. And here he is. This is the newest member of the Mighty Mike crew, and he's the new mascot of the channel, I guess. This channel belongs to him now, and he said that you guys need to hit the like button and subscribe because there's going to be a lot more content with this little guy. Oh, you smelling them treats? Alright, come back. Now let's get into what the Fed had to say. Jerome always pretty much starts off his press conferences all the same way by saying that they're dedicated to their mandate and they're going to definitely not quit until they bring inflation down to 2%. But where we get the real answers is whenever he has the Q&A and he actually talks to the press.
Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be, and that's obviously back in December, and the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%.
So basically, he just said that the median target interest rate hike that the Fed members were all thinking we were going to be getting to is between 5 and 5.25%. With us just having the interest rate raised to 4.75%, that means that we would probably have about 2 more 25 basis point hikes. Right now, according to the CME Fed Watch tool, it looks like people are expecting in the next meeting that we're going to have another 25 basis point hike with about an 84% chance. And then people are expecting them to do a pause with about a 57% chance in May. Then it looks like the market is still expecting them to hold those interest rates at 5% all the way through September, and then finally they will lower them by 25 basis points in November. But this doesn't really line up with what the Fed had to say today in their meeting.
We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data-dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those 2 options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over-tighten, but if we feel like we've gone too far, we can certainly and inflation is coming down faster than we expect, then we have tools that would work on that. So
So basically, he just said that they expect inflation to be coming down, but they would prefer to over-tighten than to under-tighten because they don't want inflation to come back. Once it comes back, then it'll be harder to get under control, And if they do actually over tighten a little bit, then they can really just start printing a bunch of money and then try to bring the economy back. Also, he said that the Fed members haven't really made a decision on whether 5% is going to be high enough for the highest interest rate hike before they actually do a pause, and they do plan to update that outlook in the next Fed meeting.
I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together. Although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So
basically, he said that he's going to have to do a lot more work until housing inflation starts to come down. A lot more work doesn't really sound like another 25 basis point hike and then a pause to me.
We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. This is a good thing. But that's around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down, this is good.
So basically he's saying that goods inflation is starting to come down, but it's going to take a little while for this to actually reach housing inflation. They don't expect people to continue to buy houses because people already bought those houses, and with interest rates going up so high, it's going to be harder for people to get into a new mortgage. So as goods inflation comes down and the rest of the economy starts to cool off, people are going to stop buying as many houses, which has probably actually already started to happen, and then the houses that are on the market are going to stay there, and they're going to have to eventually lower those prices. At that point, then it looks like the Fed is going to have one of their other things that they're looking forward to see that inflation is actually headed back towards 2%. And from what I can tell from this Fed meeting, it's basically the housing market and the employment market that he wants to cool off a little bit, because there's still a lot of jobs for how many people are actually looking for employment.
Nick Timiraos, The Wall Street Journal.
Nick Timiraos is basically the Fed's journalist outlet where he lets everybody know what he thinks he's going to be doing in the future. Or at least that's what people say. So we're probably going to get some good information here. Hey guys, I hope you're enjoying the show. I just wanted to take a moment to tell you about our sponsor, my merch store. Head on over to mightymike.io and pick yourself up some Mighty merch. Are you mighty? Well, own it. Get your hands on the hottest crypto merch on the market with Mighty Mike's Mighty Merch. Investing in style with Mighty Merch is investing in success. I've got all kinds of new cryptocurrency related designs coming out all the time, and I got the comfiest merch that I could possibly find so that you could sit back in luxury and watch my videos in style. So head over to mightymike.io and get yourself some Mighty merch today. Now back to the video.
Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above target inflation, and we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
Good question.
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive.
And boom, there it is, really. He just said there's going to be a couple more interest rate hikes, and we can all see that they did lower or slow down the interest rates to 25 basis points. So that means 25 basis points for 2 more rate hikes, and that's 50 basis points left to go. Unless he's just bluffing and trying to get the markets to cool off a little because they've been pumping a lot. But up until this point, the Fed has kind of done what they've said they were going to do, and they did just say that they had a couple more rate hikes to go. But who are you going to believe? The actual Fed who's doing the interest rate hikes, or a bunch of people that are speculating on the internet?
And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it, is basically the 3 things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, by an appropriate set of measures, are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all.
So everybody's been saying that they have to get the Fed rate above the actual rate of inflation before inflation will come down. And he just said that real rates are actually positive. So that means that according to what he thinks, they do have the federal funds rate above the actual rate of inflation. There's a lot of debate over whether the inflation rate is actually as low as it has been in the numbers that they release, because they keep changing the way that they actually measure inflation over time. But it seems like that's the kind of the level that he wanted to get to, and we're finally at that level. And it seems like they think that's why inflation is going to continue headed to the downside.
And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
You'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot.
That kind of sounded like a yes. Definitely wasn't a no.
A lot of time talking about the path ahead and the state of the economy, and I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria?
Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was wondering, if the U.S. goes past the X date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
That's a good point, because the Fed has to print the money for the government if they do raise the debt ceiling. And if we don't raise the debt ceiling, then we're going to default on our debts, and basically the whole country is going to collapse. So they're going to have to raise the debt ceiling, and that's going to mean that the Fed is going to have to continue printing, and I don't think that means they're going to be able to keep the interest rates this high. Let's see what he had to say about that.
So your question is, would we say your question again?
Will the Fed do what Treasury directs as it relates to making payments, or will it do its own analysis of any legal constraints?
So you're really asking about, you're asking about prioritization, in effect, is what
Yes.
you're asking.
Basically asking if he'll continue to print whenever Congress raises the debt ceiling.
Okay.
Yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due.
Yeah, and who supplies the money? He's not going to admit, obviously, that they're going to continue printing, because they're saying that they're going to continue being restrictive so that inflation will come down. But if you can look into the future and see that this summer they have to raise the debt ceiling, you can pretty much figure that they're not going to be able to keep these interest rates as high, and they're going to have to continue quantitative easing.
And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between.
Yeah, I mean, everybody knows what has to happen whenever they do raise the debt ceiling, and he can't actually continue to talk about that, or else he's going to have to admit that they're going to have to continue printing. That's why he just said that that's all he has to say about that.
Really, it's really Congress's job to raise the debt ceiling, and I gather there are discussions happening, but they don't involve us. We're not involved in those discussions. So
essentially, it's out of his hands. He's going to have to print, and he can't do anything about it.
we're going to be cautious about declaring victory and sending signals that we think that the game is won, because we've got a long way to go. It's the early stages of disinflation, and it's most welcome to be able to say that we are now in disinflation. But that's great, but we just see that it has to spread through the economy and that it's going to take some time. That's all.
How long do you see then the federal funds rate remaining at this elevated level?
So my forecast and that of my colleagues, as you will see from the SEP, and there are many different forecasts, but generally it's a forecast of slower growth, some softening in labor market conditions, and inflation moving down steadily, but not quickly. And in that case, if the economy performs broadly in line with those expectations, it will not be appropriate to cut rates this year, to loosen policy this year. Of course, other people have forecasts with inflation coming down much faster. That's a different thing.
Like I was just showing you on that CME Fed Watch tool, the market is pretty much expecting them to cut rates for the first time in November. But he just said that he doesn't think it's going to be appropriate to cut rates at all this year. Even if he does cut rates first thing next year in January, it seems to me like he's trying to push this thing back just a couple more months, and we might have a couple more months of rate hikes left to go. He says there's still a lot of work to do, and I really just don't think that it seems like he expects to be doing a pause after the next interest rate hike, because while he has started to see some goods inflation coming down, he's not really seeing the housing inflation coming down, and the labor market is still really tight.
If that happens, if inflation comes down much faster, then we'll be seeing that, and it will be incorporated into our thinking about policy.
So basically, it seems like we're probably going to be seeing a little bit more hawkishness from the Fed in the next meeting, and we might even see another 25 basis point hike after the next 25 basis point hike that we're already expecting. That's true if you take Jerome Powell by his word and what he said in his meeting today, which, as I said, doesn't exactly line up with what the markets are expecting. But I think it's going to be something a little bit in the middle, because I believe that Jerome Powell is actually going to possibly even raise those interest rates by another 50 basis points, doing 25 basis points in the next two meetings, because whenever we finally do reach the deadline for the debt ceiling, the Fed is going to have to continue printing money, and that's definitely going to bring inflation back. So I think that he might actually try to get ahead of that by doing another extra interest rate hike and then pausing, but I do believe they're probably going to have to cut those interest rates by the end of this year, because we're going to have to make a decision on the debt ceiling by this summer, and I do believe they're going to raise it because the U.S. is not going to default on its debts. But in the meantime, it does look like at least the Fed is slowing down the interest rate hikes, and they're probably not going to be getting any more aggressive than we've seen them be up until this point. And for that reason, it looks like in the charts we might actually have some more upside to go if we can actually make a higher high right here, and we don't get caught up by this bearish divergence here on the RSI, forming a double top here and being rejected, so that we have to come back down and find support, possibly even down at the 200-day moving average. If that doesn't happen though, and we do make this new higher high right here, it looks like we might actually be going up to about $25,000, and the rest of the market is probably going to continue to pump as well. Let me know what you guys think in the comments. Does the Fed actually have a lot more work to do, or is he really just bluffing and trying to make people believe that he's going to tackle inflation, when really he's going to have to continue printing because we're going to reach the debt ceiling this summer? Either way, thank you guys so much for watching. I hope you have a wonderful day. And don't forget, Ibisu says you got to hit the like button. I'll see you guys next time. Bye. Oh, hey, I was just being chased by a bear. Watch out. Don't forget to hit that subscribe button and that notification bell too, because I don't want you to miss out on any important updates. And check out this video. Oh crap, I gotta get out of here.